been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is multifamily investment expert Charles Carillo. Now, Charles is the managing partner of Harborside Partners, a real estate investment firm, and has been actively investing in multifamily real estate since 2006. Charles also hosts the Global Investors Podcast, where he interviews professionals about investing in U.S. real estate. And so, guys, I'm excited to introduce Charles onto the show. But before we do, just have a few quick housekeeping items to run through. The first one here being that our latest and highly anticipated mobile home park investment fund, this will be our third one, recently went live, and we're accepting capital. But I will say that space is limited, and we've had a overwhelming response, probably more so due to pent-up demand. We have not opened up an offering now for over a year, nearly 2 years since we last taken in capital. And so lots of pent-up demand, especially to get into the mobile home park space. This offering is a Regulation D 506C, and it's open to all accredited investors. And for those that don't know me, don't know my background, maybe it's the first time you're listening to the show. My team and I, we've specialized in mobile home parks for nearly a decade. And me personally, I've been a full-time real estate investor for nearly 2 decades, so almost 20 years as I age myself mentioning that. And I've owned hundreds of single-family properties, hundreds of apartment units, a litany of other different types of commercial real estate, and started buying mobile home parks again nearly a decade ago. And mobile home parks weren't really all that cool way back when. Now they've, I'd like to say the secret is out, and they've gained the attention of some very large private equity firms such as Carlyle Group and Blackstone and Apollo Group, just to name a few. And these groups have jumped into the space in a huge way, and there's limited supply. And so it's kind of a race to see who can buy the most mobile home parks. And so, if you have an interest in learning more about partnering with our team in one of the most historically proven asset classes to date, then you can head over to our website, sunrisecapitalinvestors.com. Again, sunrisecapitalinvestors.com. And when you're there, just click on the Get Started button, and you can fill out the short form and get access to our PPM and also our offering memorandum. Moving on here, guys, if you love what we're doing here at the Real Estate Investing for Cash Flow podcast, and you find that it brings value to you and your business, then 2 things I'd like you to do. Number 1, subscribe if you haven't done so already. That way you get notified of when all new episodes come out. And then the second is, if you love the show, please leave a rating and review if you haven't done that already on whatever platform you listen to it on, Stitcher Radio, iTunes, and a litany of others out there. It really helps us attract awesome guests such as Charles to the show. And then lastly, before we get on with it, just want to remind you of the free 30-minute call I offer each and every Friday. This is where I set aside 2 to 3 30-minute time slots to jump on the phone with my listeners. I've been doing this now for 6 years. I've spoken to hundreds of you, and there's no ulterior motive here. A lot of people always ask, why do I do this? And really, I just simply enjoy meeting others that share the same passion for real estate investing. It doesn't matter if you're brand new or seasoned. I've met lots of you over the years, and I always enjoy those Friday calls. I typically get as much out of them as you might. So if you want to schedule a call with me, go to my website, kevinbupp.com, and get linked up for that 30-minute call. And now, guys, without further ado, let's get on to the part of the show you've been waiting for, which is our guest, Charles Carillo. So, Charles, how you doing today, buddy?
I'm doing great. Thanks for having me on, Kevin.
Yeah, thanks for joining us here. Excited to have you, man. Where I'd like to start this off, Charles, for those folks that might not be familiar with you, don't know your name, don't know what it is you do, maybe tell us a little bit more about yourself, what you did before real estate, how you were introduced to the business, and then exactly what Harborside Partners does today.
Yeah, sure. So I've been investing myself in multifamily real estate since 2006, commercial real estate since 2009. And I'm originally from Connecticut. I moved to Florida in 2012, and I got into real estate investing. My father was a very large investor, from developing properties, owning a lot of apartment buildings and mixed-use properties. And he self-managed everything with a small team. He didn't have any management companies when he worked with it. So it was very hands-on when we would when we'd be managing those properties, I guess you would say both of us. But we were going back and forth on all different types of assets that he had. And it was everything from owning restaurant space to, like I said, mixed use and a lot of apartment buildings. So that's kind of where I got started and working with real estate. And I didn't really get the bug until I was a little older. And because my dad's properties were more C. He had some C plus. A lot of it was C minus and D. Ooh. Which anybody that's ever worked in that space before, it's not something not very glamorous, right? As all these podcasts kind of show you what multifamily is like. It was nothing like that, and a lot of problems. And when I started buying property, he wouldn't allow me buy anything that was lower than C was the lowest he would allow me to go. So when I would bring property to him, he's like, no, it's not a good neighborhood. It's not this, it's not that. And I thank him and on that, because that's usually one of the big mistakes I think a lot of new investors make when they're looking at properties. But so I started with that. I was in college. I was running a small payment processing company. And since then, my brother runs that full time, and I'm full time in real estate. And with Harborside Partners, what we do is we syndicate properties. We're in multifamily properties is our what we really focus on currently. And it's mainly all throughout the Southeast. And I'm being based in Florida. Florida is definitely a major target market for us. And we're purchasing properties, typically 75 units plus. We've done some smaller properties before in the 50 to 60 unit range, but the majority of the properties we're dealing with are 75 or 90 units plus, something like that.
Mm-hmm. Got it. Good deal. I appreciate that background. And I want to back up a little bit, when you were growing up and your father was, owning and managing these C minus and D grade properties, did you realize, at a younger age that your father owned challenging properties, or is it just all relative? Like you only know what you know at that point?
Yeah, I had no idea. Well, I thought everybody I didn't really know too many people. We grew up in kind of like an upper middle class area in Connecticut, and I didn't really know anybody that lived in an apartment growing up. So when someone said living in an apartment, it was like, I just always compared it to that. I remember watching a Yankees game one night, and they're saying about one of the players that had just bought an apartment in New York. And I was like, why would somebody buy an apartment? This guy's like a millionaire. He's on TV. And my dad's like, there's a lot of nice apartments in the, it's a completely different ballgame that, you know what I mean? Like in so many words. And I was like, oh, okay. Like I had no idea of this stuff when you're growing up and you see, you just kind of like you said, you're just apartment and it's this, but as you get more into it, and my dad was kind of broadening his horizons, he started buying actually in the Northeast. There's tons of like 3-unit properties, right? Small multifamilies. And he started buying more of those because they were easier to in better areas, and you're getting better tenants with them. Mm-hmm. Not saying that, in the Northeast, we don't have as big of complexes, I would say, in the Connecticut. Maybe in other parts of the Northeast we do, but in Connecticut, there wasn't huge complexes like we have down in Florida or in Atlanta or Dallas or something like that, where you have hundreds and hundreds of units. It's really like you'll have a 3-unit, a street of 3 units, then you'll have a 10-unit, you'll have an 18-unit, and then you'll have a couple mixed use on the corners. And that's kind of how the layout is. So he kind of, before he started liquidating a lot of his properties, he kind of was focused more on buying in better areas, and it was a lot less hassle. And he was getting rid of problem properties that, if held on till now, they've actually come around, but they weren't coming around when he was owning them. So
yeah, no, I was going to ask you the question of why didn't your father heed his own advice when he was, he wouldn't allow you to invest in anything lower than like a C+ grade property. But it sounds like he did. He changed his game up a little bit as he evolved, and as he realized that maybe he didn't, he could still make money without dealing with so many headaches associated with some of those really low end apartment complexes. But you got to cut your teeth somehow. I mean, the first types of properties that I ever owned were the C-. I don't think I'd ever classify maybe a few select D grades here and there that were just, by accident. I didn't realize that they were as bad as what they were, and they just never attracted anything better. But I've always dealt with that C- grade type asset. And, it's all about the systems and processes, right? That, hopefully you're getting a higher return for the effort and work that you're putting into them. But it's funny looking at today's market, especially the multifamily space and even the mobile home park space, you're seeing a lot of, there's not much of a return premium or yield premium that one can expect to take the additional risk of owning a C grade multifamily property or C grade mobile home park versus that of maybe a B grade, right? And so the margins have gotten a lot thinner. And I know back when I started buying property, you could expect it of, hey, if I'm going to step into buying this headache of an asset or a little bit more challenging part of town, I'm going to expect a much more significant return for the risk I'm taking. And that's been compressed a lot, especially in our two niches here over the last couple of years. And so with that being said, talk to me about kind of your strategy here over the last couple of years. Are you buying C grade apartment complexes? Are you buying nicer than that? Like, what is your business model today?
Well, really going back to what you're saying about the different margins and the different grades, that's completely true. The other thing too is, especially if you're buying in a growing area, people think that wave of gentrification is going to come a lot sooner. And I think that if you're buying lower grade properties or in areas that aren't as great, people are more likely to kind of sharpen their pencil on those deals because they feel that wave of gentrification will come over them and they'll be able to profit. But it's still, what we're looking at is we're really looking at I really like C plus areas and above. And it could be C plus and above. That's really where it can go, or it has to be the ability where I see a neighborhood that's actually going to be there. And you want to be, when we're looking at properties, I want to drive around and I want to see already value-added properties in the immediate area. I want to see some that are for sale. I want to see some that have work being done. You know what I mean? Mm-hmm. You kind of want to see that wave when you're in those C plus areas. And B minus, you're not going to see it as blatant, but different areas like we've been purchasing consistently in like parts of Tampa, North Tampa, and you can drive through the areas and you'll see dumpsters, crews here doing stuff. A nice property over here that's probably B minus quality, that was probably in tough shape a few years ago. And you see money coming into the area, and when you're purchasing, you and your investors are going to be able to kind of ride that wave of gentrification that's going to come through. And maybe a few properties that haven't switched hands yet, those are the ones that are really going to define the neighborhood. Once those are done, it's really kind of going block by block. And that's, I think, kind of a goal of how you have to get a little bit more creative in these markets. It's because you're not going to get the returns by just buying retail and bringing the investment to your investment group. You have to get, like, we've been purchasing properties and putting together portfolios. So our last property we bought was 90 units, and it was a 22 unit and a 68 unit. Mm-hmm. So you kind of were off this. You were kind of off the. You were out of sight, I guess you would say, from larger syndicators that probably only want to deal with 100 units plus on one property. And but what we did was we were able to get scale of economy on that because we had the 22 was a little tougher of shape, but the 68 was on its way to almost being stabilized when we purchased it. So it just made the investment a lot more solid by having those two different properties and getting a little bit more creative when you're putting them together. And I think that's what has to happen at this point. When investors are looking for deals, they kind of have to think outside the box, Mm-hmm.
Yeah, no, absolutely. I agree with that wholeheartedly. And speaking to identifying those areas of gentrification, where the wave is heading or where the wave is going. Obviously, you're based in the Tampa area, Tampa St. Pete area, and you gave an example of North Tampa, but but that's local, right? I mean, it's in your backyard. It's much easier to see and identify those things when you live in and around it on a regular basis. But how have you gone about, identifying markets and getting comfortable in markets outside the Tampa area? And I guess that's assuming that you actually are invested outside the Tampa area. Is that the case?
Yeah, we've been underwriting deals. When I say like all throughout the Southeast, we've been over the last month, we've been underwriting deals as far out as, we have a group that we work with and partner with in Oklahoma, and we've been looking at deals outside of Tulsa. We've been underwriting deals Alabama, Arkansas, outside Atlanta. So we've been really looking at everywhere. And it's really, you can do that when you have a proven team on the ground that has asset management in place, right? And they have a solid background and experience in that. And it makes it much easier because when someone brings us underwriting, they might bring us a deal and they say, hey, this is what we need. This is what we're looking to partner on. And here's our underwriting. And then what I can do is I and our team, we can review that. We usually send it out as well to third-party underwriters if we're interested in moving forward. So we get kind of a non-bias. Mm-hmm. opinion on the deal. You know what I mean? And they'll tell us this is too aggressive and this is right on. And then we kind of make our decision from there on the different points of the underwriting. But you really, after we have something, then you can really dig into it. And just by pulling knowledge off in a couple hours online, you can really figure out and kind of see the growth of different areas and compare it to the US average and then compare it to other areas that you've invested in, and then kind of figure out your plan. The pro about in Tampa is we've had so much growth down here in parts of Florida. And it's probably one of the best markets in Florida to invest in, I feel, where you're getting price to value. There's some other markets with growing, a ton of places with growing population, like Southeast Florida, but it's very expensive. So I think that, Jacksonville, Tampa are great areas for investing. The whole I-4 corridor through Orlando. I know Orlando's kind of had a little pullback here with what's going on in regards to being tourism and hospitality heavy. But anyway, when you're looking at this, you can see these rent increases, and obviously, these rent increases will not continue like they were. But you still see the job growth. You can still plan out and see what your 10-year job growth is, and then you can compare it to other markets. So you can make money going into areas that might not be as heavy in appreciation as, say, Tampa, but they might be more cash flow heavy. But you just have to make sure that you're buying it at a great discount, because if you're going to go in there and do a management play, you're not going to have the leniency, let's say, if you are a little too aggressive on rents. Maybe in a market that's growing very quickly, you'll hit those rent targets in a year or two past what you thought. If you're in a cash flow market and you've been too aggressive on your rent estimates, it might be several years, you know what I mean, until you hit them. And that's just your whole productions are just gone. So you have to make sure that when you're buying in these areas where you don't have as much growth, you have to really make sure you're getting a deal on it.
Yeah, no, great points. Speaking to Orlando, as it relates to the pandemic and just the tourist industry and the hospitality industry, just getting absolutely, their butts kicked. Would you consider an investment in Orlando today, given the state of affairs that we're currently in with the pandemic? And I know Florida's been way more open, and businesses back in operation. When compared to other states throughout the U.S., majority of the other states. However, it is still absolutely getting crushed. People aren't traveling. People aren't traveling to Orlando like they would have in the past. Disney, I know they've been open in a limited manner, but they're still not seeing anywhere near the attendance that they normally would. Restaurants are ultimately being affected by that. Yada yada yada. It continues downward as a spiral. And so, would you consider Orlando today, where we're at this current state of the pandemic?
Yeah, I mean, I don't mind buying in areas that possibly are going to be, I just need to get a discount on it. You know what I mean? So it's when I'm looking at operating memorandums or performers that are coming from brokers on deals that they sent us in January of 2020, and now I'm looking at them in 6-8 months later, and the price is still the same. Well, and then I look at the financials and I see that, collections have been late. There's tons of late fees. There's all the other things without really digging into it just on the surface. And that there's the tenant base is not as strong as it was pre-COVID, right?
Yeah.
So would I buy that? Yes, I would. But I'm not going to buy it for the same price. I have to get some sort of discount for the additional risk we're taking, because normally when we're buying a property, we can start our distributions right away. If we're buying a property and if we were buying a property in Orlando, I mean, you might not start your distributions for 6 months or 9 months out, because you want to make sure that you're doing some sort of initially stabilizing the property before you start sending out money. So my investors have to be compensated. We're putting money alongside as well. We have to be compensated. Everybody has to be compensated for it. It's just that, you're seeing deals that come through, and I'm on broker list for Orlando, and I see them come out, and it's just completely nothing's changed really. I call it the 90 days of the beginning of COVID. People were conservative. And then I started seeing it it was day 91 of COVID, and people are like, we're doing deals, and and everything was the same as before. And you're like, okay, well, that's great. I mean, if you have that, if you feel comfortable in that, but certain areas of the country were really hard hit. I mean, Florida wasn't that bad. Orlando was. A couple other smaller areas in Florida were above average in unemployment, but it was nothing like Las Vegas or something. The whole Southeast did pretty well, I feel, because it's a much more diverse economy than, say, we had 15 years ago. You know what I mean? Yeah,
I agree. Did you guys see any kind of downtick on your collections throughout your portfolio?
We have, and we've seen we're right around we're hovering on our delinquencies in the mid single digits. So it's not that bad. Mid to high single digits is really what we're seeing. It's really, typically what you'd have after the first Friday, right? And when you're dealing with C-class properties, no matter when that Friday, what day of the week that is, you kind of have an idea at 5 p.m. exactly what your collections are. With COVID, it's now after the second Friday is when you have an idea of where stuff is. So people are paying, we have very minimal. I think at one property, we just have one CDC letter that came in. And so it's not, people are paying and there's not too much of an issue. Obviously, you have to work with people, especially when you're in C-class properties. Maybe B-class, you don't have to as much, but with C-class, you really have to, you have to work with people. But people still in B-class, I see people, a lot of operators there have opened up no fees credit card payments, trying to get people to pay right to keep with paying that 3% for them to keep those collections on the first, right? So they can keep on paying out distributions and everything's running smooth. They don't want to take partial. In C-class, you can't just require full payment or your property will go under. You have to take money as people give it to you. And that's the thing about having offices on site where people are paying you. So
yeah. No, we actually did a shift like that as well. Up until I think August was when we ended it, where we basically waived all merchant fees, what have you, and just basically made it as easy as possible for folks to pay their rent and to pay it in full. But yeah, we've noticed a little bit of a downtick, not overly significant. Now, some assets have done way better than others. It seems like more of our the communities that we own in more of liberal states, not being political at all, but just generally speaking, have seemed to have done worse than that of others in more conservative states. And so, which, it is what it is, but, still not anywhere near, where I thought the collections, how bad they could have gotten. March, I could tell you, lost many nights of sleep as we rolled into April, wondering how the collections were going to be, at the first of the month. Yeah. And so exceeded expectations. I'll leave it at that. So with that being said, I'd like to shift over to the starting of your company. You founded the group was back in 2016. Is that correct?
Yeah. That's correct.
Okay. Talk to me about some of the growing pains, that you faced getting into this. I know you bought some properties prior to that, but really this business today is a very different structure. You guys do syndications, lots more moving parts involved. And so talk to me about some of the initial growing pains, what they were and how you overcame them.
Well, when growing up and doing stuff with my dad, he's a very back of the napkin investor, like old school kind of thing. So it was, when he was buying properties, it was back when people would just sign properties over to you, right? And you'd actually get money back at closing. The whole 80s and 90s stuff, right? That's someone offered me that once in 2005, and the property made no sense. And I was like, I never did it, but I was like, my dad was like, let me see this. I haven't heard of that in 20 years, and that should have been my inkling not to buy in 2006. But anyway, when we're looking at properties, it's a much more calculated, right, way of doing it, where we're doing underwriting. We're actually, you're doing out projections for years. You're figuring out, when you're dealing with larger properties, you're figuring out your downtime. You have to be conservative. It's very easy when you're doing these value add to be very aggressive, because I think everybody, if you're doing any type of value add, it's an aggressive underwriting formula, right? So you have to make sure that when you're doing it, and that's the first thing when people send me deals, whether they want me to be a limited partner, whether they want me, us to partner as general partners on it, it's really taking away the rent increases and seeing kind of where it is. And that's the first thing, because it's the easiest thing to do. I'm not an underwriter 100% myself. So it's something that when I'm reviewing it, I want to see what the rent increases are and see what happens when you start changing those, you know what I mean? And lowering them to something that you can get right now. And I think, when we're doing underwriting, it's really just making sure that you're going through and you're making sure that the property you're purchasing is how you're purchasing in the beginning. I mean, we like long-term debt, and we like doing it with pretty substantial solid reserves. And that allows us to go in and be confident when we're working on the property, when we're value adding on the property, and we have a business plan that we can execute on, and that will kind of meet or exceed our expectations for the property. Now with COVID, kind of throws a wrench in it, but now that we are underwriting with COVID, you're kind of underwriting out a year without rent increases, and you're spending 6 months just to get people everybody on track, everybody paying, everybody going. Because when you're buying a larger property, it's much different than a smaller one. Smaller property, you can, you knock on 5 doors and everybody knows you're the new person. Everybody's paying you. It's not like you have vendor contracts with big stuff. It's nothing like that. With larger properties, I mean, just switching your trash vendor can be a mess. You know what I mean? And getting that all set and having tenants, you've gone through properties, you're walking them again. Really that 90 days of when you've purchased is figuring out exactly what is really going on at the property. We're going into properties that were supposed to be, that were vacant, that are not vacant, that, you have never spoken to tenants after 45 days. And you're like, is this even, this kind of stuff we're going through when you're dealing with mom and pop properties and you're kind of bringing them along and value adding them. So it's like, there's a lot more underwriting and there's a lot more requirement for doing due diligence on the properties. And you can't just, especially with investors' money and, it's not the small, it's not a small problem if something happens, right? When you're dealing with 200 units versus 20. So
yeah, no, great points there. And I guess I'll make the assumption that the deals you guys are buying, they qualify for Fannie or Freddie out of the gate. And when you say we'd like to put long-term debt on place, I mean, is that your minimum criteria? They've got to be Fannie or Freddie ready today?
It depends. We're in the process of underwriting one right now that it would go on bank debt, and because it's a pretty substantial, it's a management play. It's actually a really nice property. It just was kind of run into the ground by the current owners, and so it's not a do or die kind of thing. It would just have to be that the team that we're partnering with or what we're working on that property. What our goal is that we have there's other experienced operators on the deal with us that we have a team on the ground that's going to be able to handle it. Because when you're dealing with so many, the last property we were looking at, it was 290 units and 70% occupied. They only had 2 people working out of 300 units, like 200 on-site people, which they should have 6, right? At least. So it's something that you can just see that right off the bat, they have 80 vacancies. You know what I mean? That you can, and built in the mid 80s, right? So it's really, you can rent them as they are, or you can spend a few thousand dollars and get them up to the next level of 2020 level and rent them. So stuff like that we're looking at, we would take bank debt on, and it would be a little bit more of a short term, and it would be something that we would be refinancing. But when you're doing a project like that, the amount of value you're going to add in that project, and it doesn't matter, that project will rent, that project will be successful with or without COVID, because it's not like we're going in and saying, hey, rents are 1,000. And in 2 years, we need to get them to 1,250 to hit the number to refinance. You know what I mean? And that's a very aggressive strategy right now with people that are doing something similar to that with COVID. Because raising rents, it's very difficult for me to kick out someone that's paying or not renew their lease that's paying to spend thousands of dollars in the unit to try to raise rent, $150 a month and try to re-rent it at that rate. You know what I mean? It's a much safer proposition where, okay, if I have a totally trash unit, we'll put the money in there and we'll fully value add that unit. The other ones, maybe we just put a few $100s in, you know what I mean? And add $15-$20 a month to the rent, and we re-rent them. And little by little, we're doing 1 or 2 units. And that's usually kind of how we're doing it with what we have going on now. It's like 2 units a month is kind of how we're doing it at this point. And it's just the most conservative way of doing it, because then you have an idea, because right off the bat, it's one thing if you have 5 vacant units and you're like, oh, we can rent these right away. Well, then you can look back and go, maybe we'll go down to 1 unit because these 2 units took us a little longer to rent, which I don't think would be an issue. But that's kind of different things that you have to think about. And it's very difficult once you've kicked out people that are paying with jobs and stuff like that during COVID. So
yeah, no, all great points there. And, speaking to the example you gave of the apartment complex that it's not ready for Fannie Freddie today, it's going to be bank debt. Most of it is a management play. Can you speak to some of the major inefficiencies? I think you gave one, which was they've got 2, and I think that was the same property. They got 2 members on staff there at the site, whereas based on the size of that complex, it should be 6. What are some of the other big inefficiencies that exist on the management side of that property that you guys know you can fix?
Just going in, it's really that they didn't really have any marketing done. And it's always a thing when you have a property like that, 300 units, let's say, and the owner was working on site, which is the craziest thing I've ever heard of. It's a single owner and he's working on site. And you're like, usually you never even talk to the owners at these properties when you go in them, and you could actually like talk to the guy. So that was kind of odd. And that's something they're when we were looking on like apartments.com and we were reviewing what they were renting for. And I had some partners that were driving the area, and they're telling me, they're like, listen, this is like, it was built in the 80s. So built in the 80s is great for multifamily investors because we don't have to worry about aluminum wire. We don't have to worry about asbestos. We don't have to worry about lead paint, any of this kind of stuff that's really hinges for properties that are older. And so when we were looking at it, and there's no flat roofs, all the things, it was checking off all the boxes, but they just didn't really have any type of, their marketing was terrible, right? And the marketing was one problem. The other problem is they didn't have the staff to turn units. Mm-hmm. And so you would be looking at properties, units, and not like there was major issues with it. It was normally, hey, send two people in to paint it. It could be done in one day, and or change out some vanities, change out counters, or change out cabinet fronts, whatever might be the plan of how much renovation you want to do to it, but it just wasn't being done. So going into that, you're really just taking inventory that's not there. And even if you're saying, okay, I can get $700 a month for this apartment if I do it nicely, let's say, maybe I rent it as it is. Maybe I just put a little bit of money into these and rent them for $575. You know what I mean? And that's additional money right there that's coming in that it was never there before. And that takes a much longer value add. Obviously, the right way you'd want to do it to really maximize investors' money would be to do the majority of the value add and get the majority of the rent increase as soon as possible.
Help everyone understand an individual that owns a 300 unit apartment complex. He owns it as an individual. It's his, right? He's not a big investment group. It's this individual's. At some point in his life, he was a incredibly sophisticated business person of some type. I don't know what his past is, but somehow he accumulated enough capital to buy what was still, even back in the 80s, or either he built it or he bought it, was a multi-million-dollar property. Help folks understand how that individual can do such a horrific job of managing an asset that he has dumped, again, probably tens of millions of dollars into. It's hard to understand, and I know they exist out there, but from your perspective, what really went wrong?
I think it's one of the things when people don't. I've seen this all through. I mean, you've purchased a lot of properties from mom and pops, Kevin. I mean, you're dealing when you look into a property, and we see so much. But when people don't have debt on the property, or they have very little debt on the property, it's a much different. And they don't have to answer to anybody. I mean, if you own a property full right out, and you don't have any investors, and it's the same person when you're looking and you hear all the time, renting for $800 a unit, and then market's $1,100, and they've owned it for, let's say, 30 years, let's say, or whatever it is. They don't have to raise the rents. They don't want to deal with the management issues with raising rents, with doing the marketing, with renovating the units. They want people in there that never call them, and they'll never raise their rent, and that's fine. Everybody has their own investment criteria, right? Their strategy, and it's like the strategy of not doing anything. But you look at it all the time with people. I mean, when I was growing up in Connecticut, I remember I had properties next door to my first 3 units we bought, and people would live on the first floor, paid off. They wouldn't rent out the top 2 floors. And they had it all paid off. They worked in, they're tool and die makers for Stanley Works or something like this. And the place was paid off. They haven't rented it in 15 years. You know what I mean? And they just don't want to deal with tenants. You know what I mean? And they could be bringing in $900 a floor. You know what I mean? They don't have to deal with it. So it's something where everybody has their own strategy. And when we're looking at it, you can see, and you just see how undervalued it is. You know what I mean? And, you have to be a little conservative when you're looking at it, because you have to think, well, this is great, I can rent them, but how many, if you have 100 units that are down, or 80 units that are down, to renovate them, and, how many crews you really need if you want to do that, and the marketing campaign to get the people in there. And if you're in a high growth area with a lot of people moving in, that's going to be a lot easier. If you're in an area that is not as fast in population growth, let's say, it's going to take more time. And even if the units get fixed, you have to have that kind of, you have to equilibrium where you're fixing units and you're getting them rented within a couple of weeks. You don't want to be putting money out and have them 2 months waiting to be rented. You want to have them fixed. You want someone signing to move in within 2 weeks, let's say,
Well, while we're on that topic, and let's talk about this as though we're, either pre or post COVID times, when you're doing a rehab project, doing a large value add on a property, how do you determine how many improvements to make, whether it be to the specific unit itself, to the property overall? How do you determine how many improvements actually make and how much to spend as to not over improve that unit to where you're not going to, see the benefits or the additional return of investment on that additional capital?
Pre-COVID, it's really that you want to get your money back on the improvements you're making within 36 to 48 months.
Okay.
That's kind of how we would plan it out. So if you're going to put $3,600 into a unit, you want to see if you can get $100 a month increase in rent, let's just say, as easy numbers. Now with what's going on, it's really it's more of a asset management play where we are during COVID. And I think everything will continue with value add, maybe not as strong as it was before in certain areas, but it will after COVID. And, as COVID kind of little by little, I guess, decreases here before we get a vaccine. But, 2022, maybe 2021, we might see something like that. But I think as it is right now, we're going to be, when you're working on it, we're kind of really focusing on smaller, you're obviously doing a lot of your CapEx on the common areas, right? So you can take care of that at any time. So that's something that you purchase a property, you're going to go through, anything with ACs has to be done. Anything with roofs has to be done. Those are easy to be taken care of right away. Not really adding to your bottom line though, right? People aren't going to pay more because their roof's not leaking. So that's kind of one of the
won't.
So they won't pay rent because of the roof's leaking, but they won't pay more if it's not. So it's one of those things where we're just going in kind of some of these areas, and I call it kind of initially stabilizing the property. And you might see, like we said, you might have that down unit and you might say, you know what, we don't want to put out $4,000 into this unit. Safely, we probably can get $50, $75 more a month. Maybe we just go in and we change the vanity and we paint it and we do it like real deep clean, and we're out for $1,000 or $800. And like I said, maybe adding $20 a month or $30 a month, whatever it is on top of it. And just getting it rented by someone that's a solid tenant, which is really the most important part right now, is renting to someone that checks off all the boxes and making sure they have pay stubs. They're a good tenant that passes the lease audit. You know what I mean?
Yeah. I've been overly surprised. I have seen more applications come through our funnel. So we own our own property management company, and I peek in, a couple times a month just to see what type of quality we have, especially during COVID, we have coming through, applying to buy units, what have you. And you would not believe the number of folks that have applied that are unemployed, literally trying to buy or rent something, that literally are listing their unemployment income on the application. It's a significant number, which I shouldn't laugh. It's a sad state of affairs. So it's not a laughing matter, but I'm just shocked that folks would even consider, hey, I'm going to get approved. I'm going to go ahead and pay the criminal application fee.
It's the people with the criminal check too. And you're like, you weren't planning on that felony to come up. Well, I mean, you spent $40. If you spend $40, you're not getting back on the application fee, or $50, whatever it is.
Right.
But you didn't think that felony was going to come up, and you're like,
do you want to tell me about these 3 pages of rap sheet that it's printing out?
It's crazy.
My record's 14 sheets of somebody that told me that I wasn't going to find anything. That was years back. But I'm not like a never ending report. It was the longest thing I've ever seen in my life. So, well, man, this has been a lot of fun, Charles. Lots of great information, insights that you share with us today. And, what I'd like to ask of you is, before we wrap things up here today, if you had just one final golden nugget of advice or wisdom that you can leave with our listeners here today that might inspire and motivate them as they progress in their own real estate investing career, what would that one last golden nugget be?
I would say become strategic about what your actual goals are 5, 10 years, 15 years down the road, and then kind of figuring out what you need to do monthly or weekly to attain that goal. And it kind of makes it a lot more actionable, and it makes it easier for you to kind of plan. So if you say, 10 years, I want to be doing this, and then what do I do to get to that goal? And what kind of properties do I have to buy? How do I have to invest? What type of What size properties, what kind of partners do I need? And thinking about that more now than just going out and saying, you know what, I'm just going to buy this 3-unit. That's going to work well, or whatever it is. Maybe it's better, hey, I work with another partner and we buy a 15-unit, you know what I mean? Or whatever it might be. So thinking outside the box and being strategic is something that I wish I had done earlier in my career. But
No, that's great advice. Are there any particular resources or books that have had a major impact on your life that really helped shift your way of thinking?
There's a couple different 80-20 books, and those are fantastic.
Yeah.
It's in anything you're doing, especially like with sales. If you're anywhere near involved with sales, it's going to be good. Reading another one like The One Thing, which is another great thing by Gary Keller, fantastic about just not multitasking. So another great thing about being strategic with your day and focusing on what actually goes to the bottom line and what's all fluff, and then just focusing more on that and taking as much stuff that's considered fluff off your table and have someone else do that. So,
Charles, where can the listeners learn more about you and your company and what you guys have going on?
So if you're interested in investing passively or actively in real estate, set up a 30-minute call with me. It's free. You can go to my website, charlescarillo.com, or just go directly to the page at schedulecharles.com. And let's talk and see exactly what your goals are and possibly working together.
Good deal. Awesome, buddy. Well, Charles, it's been a lot of fun having you here, man. Thanks for joining us, and lots of great information you shared, my friend.
Thanks, Kevin. I'll talk to you soon.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Buff, wishing you huge success. You take care.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.